Tesla can already make investors feel like they are riding in a sports car with the steering wheel occasionally coming off. Now imagine bolting an income machine onto that ride. One fund sells some of Tesla's potential excitement to create monthly cash. The other amplifies Tesla's weekly movement while sending cash out even faster. The higher headline yield belongs to the fund that still lost money after all recorded distributions were counted. The lower-yielding rival finished positive on that same simplified test. Same famous stock in the engine room, very different machinery, very different condition of the patient. On one side is the curve yield premium strategy Tesla ETF, ticker TSLP, launched October 27, 2023. It is an actively managed derivative income fund designed to turn Tesla volatility into current income while offering capped gains tied to Tesla. There is no conventional index underneath it. The portfolio lists United States Treasury bills at 117%, and the Fidelity Investments Money Market Government Portfolio, Class I, ticker FIX, at 4% plus 3 call options and 1 put option written for premium income. That strange-looking portfolio tells you what TSLP is not. It is not simply a vault stuffed with Tesla shares. Its foundation is cash-like collateral and short-term government paper. On top of that foundation, the manager builds synthetic Tesla exposure with standardized exchange-traded options and customizable flex options, then sells option premium through the written contracts. Think of it as renting out part of Tesla's possible future movement. The rent arrives as option premium, which helps fund the monthly distribution. The tenant's bargain is the important part. When Tesla surges, some of the upside is capped or surrendered because the fund sold claims against that movement. When Tesla falls, premium may soften the blow, but it is not a force field. The fund can still lose substantial value. On the other side is the Roundhill Tesla Weekly Pay ETF, ticker TSLW, launched February 19, 2025. It is also actively managed, but it belongs to a different species. Leveraged equity trading with a weekly distribution wrapper. It seeks weekly distributions and 1-2 times leveraged exposure to Tesla's weekly price return. Again, there is no conventional index. Its listed holdings are Tesla Inc. Weekly Pay Swap NM at 102%, United States Treasury Bill at 89%, and Tesla Inc., ticker TSLA, at 18%. TSLW's central machine is the swap. That contract is designed to deliver amplified economic exposure to Tesla's weekly move, while Treasury bills support the structure and the direct Tesla position adds stock exposure. If Tesla rises over the relevant weekly period, the targeted exposure magnifies that price return. If Tesla falls, the same 1-2 times design points the magnifying glass in the painful direction. The weekly payment schedule does not create a separate profit source by magic. Cash leaving the fund still has to be supported by the portfolio's economic results and capital. A distribution can be cash in the holder's account while the fund's own value is being depleted. So this is not covered call fund versus slightly more aggressive covered call fund. TSLP is an options premium machine with capped Tesla gains. TSLW is a leveraged weekly Tesla exposure machine that also sends out weekly cash. TSLP sells away some potential excitement to collect premium. TSLW deliberately amplifies the weekly ride and distributes cash along the way. They orbit the same underlying company, but one harvests volatility and the other turns up the voltage. This is research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold either fund. ETFs can lose value, including funds that make frequent or high distributions. Distribution rates, portfolio positions, option exposures, swap terms, tax character, and fund policies can change. Verify the current prospectus, shareholder reports, distribution notices, holdings, and other official fund documents before making any decision, and consult a qualified professional who understands your circumstances. Now we can examine the bait on the hook without pretending it is the whole fishing trip. TSLP's headline distribution yield is 29%, paid monthly. That is genuinely extreme income territory, not an ordinary dividend yield with a little extra seasoning. Since launch, the fund has sent out $18.44 per share in cash distributions. The 1% expense ratio is the stated cost of running the strategy. The fund has $16 million in assets under management, so this is a small product, not a giant household name ETF. TSLW turns the dial further. Its headline distribution yield is 49%, paid weekly, with $28.43 per share in cash distributions since launch. Its expense ratio is 0.99%, almost the same stated fee as TSLP's, while assets under management are only $1 million. The payout rate is higher, the payment rhythm is faster, and the asset base is much smaller. But headline yield is a rate attached to a moving base, not a certificate saying the investor became richer by that amount. Imagine cutting a pie into very frequent slices. A weekly serving schedule tells you how often a slice reaches the plate. It does not tell you whether the bakery is producing new pie quickly enough to replace what was served. The same warning applies to a monthly schedule, just with fewer envelopes. The direct comparison is therefore clear but incomplete. TSLW wins the headline cash rate contest at 49% versus 29%, and weekly deposits can feel more useful to someone matching cash flow to recurring expenses. TSLP's monthly schedule is less frequent but still aggressive, and its cumulative cash paid per share is lower. Yet the funds began on different dates and at different reference prices, so cumulative dollars alone are not a fair victory lap. TSLP has had a longer period in which to operate. TSLW started later with a higher launch reference price. The distribution pile must be judged beside what happened to the capital base, not awarded a trophy in isolation. Fees do not rescue the comparison either. A difference between 1% and 0.99% is not the plot twist here. The dominant questions are whether the portfolio's strategy earned enough to support the cash leaving the fund, whether the shareholders' remaining claim retained value, and whether the payment pattern held up. The headline yields answer none of those questions by themselves. For an everyday investor, the practical lesson is to translate yield into source. A high distribution can reflect income, realized gains, strategy-related cash flow, or capital being returned. The account statement may label the incoming cash neatly. Your net worth only cares whether the full machine added value after the outgoing slice. Net asset value is the per-share value of what remains inside the fund after the distributions, gains, losses, expenses, and strategy effects have done their work. This is where the patients stop looking alike. TSLP began from a launch reference price of $24.06. Its latest NAV is $13.86, a NAV return since inception of negative 42%. In plain English, the share's internal value lost a large portion of its starting level. That decline is severe and the monthly cash did not prevent it. But for this particular fund, the falling NAV is only one side of the ledger because the strategy intentionally moves value out through distributions. TSLW began from a launch reference price of $50.11. Its latest NAV is $16.81, a NAV return since inception of negative 66%. That is a substantially deeper collapse in the remaining per-share value. A holder looking only at the rapid cash arrivals could miss how aggressively the container itself was shrinking. The head-to-head result is decisive on capital preservation. TSLP held up better. Negative 42% is still ugly, but negative 66% is worse by a wide margin. TSLW's leveraged weekly objective helps explain why the ride can be so unforgiving. Amplified exposure does not distinguish between favorable and unfavorable Tesla weeks. The cash schedule may make the experience look smoother in an income column, while the NAV column records the damage in full. For TSLP, the capped gain design creates a different NAV tension. Selling claims on upside can produce premium today, but it can leave the fund participating less fully when Tesla runs higher. On the downside, collected premium offers only a limited cushion. That creates an asymmetric path. Some explosive upside can be exchanged for current cash, while large downside still reaches the portfolio. The NAV path is the scar tissue left by that bargain. This matters because future distributions are paid from the fund that still exists, not from the fund that existed at launch. A lower NAV means a smaller capital platform trying to sustain an attention-grabbing payment policy. It can also make a headline distribution rate look elevated because the rate is measured against a depressed share value. That does not automatically make the fund fraudulent or broken. It does mean yield stayed high and capital stayed healthy are completely different statements. A viewer should also resist the instinct to compare the latest share prices as if $16.81 must be better than $13.86. The funds started from different reference prices. The meaningful comparison is the percentage path from each starting point. On that basis, TSLP lost less of its internal per-share value. TSLW retained far less of its starting base despite delivering cash more often. NAV tells us what remained in the vehicle. Total return asks what happened when we put the distributed cash back on the evidence table. TSLP's supplied simple distribution inclusive return is positive 34%. That changes the diagnosis. The share price alone looks badly wounded, but the combination of remaining value and cash delivered produced a positive all-in result in this simplified record. TSLP did not preserve its original capital shape, yet it did more than merely mail pieces of a shrinking account back to the holder. The total outcome exceeded the starting reference value. TSLW's supplied simple distribution inclusive return is negative 10%. Its larger pile of distributions did not repair the deeper loss in the container. This is the crucial contradiction. TSLW produced the flashier yield, the faster payment schedule, and more cash per share, but the simplified all-in result still finished below the starting line. That makes TSLP the stronger performer on the measure that combines cash received with value remaining. Positive 34% versus negative 10% is not a cosmetic difference. It separates a strategy that, over its supplied history, compensated for NAV damage from one whose distributions failed to make the holder whole. There is also a fairness point. These are since inception records from different launch dates, so they are not synchronized market period returns. TSLP began in 2023, TSLW began in 2025. Each fund encountered a different slice of Tesla's notoriously eventful history. This comparison tells us what each machine delivered over its own life, not which manager would win under identical conditions. A perfectly controlled experiment would require matching dates and a more complete reinvested return series, neither of which appears in the supplied data. The word simple matters too. This distribution-inclusive calculation treats the cash as cash received and combines it with the latest NAV. It is an intuitive autopsy tool, not a full personalized investor return. An actual holder's experience would depend on entry price, timing, reinvestment, taxes, transaction costs, and whether distributions were spent or redeployed. Those details are absent here, so we do not manufacture them. Still, the available evidence answers the central question. Did the payout offset the erosion for TSLP? Yes, and by enough to leave a positive supplied result. For TSLW, no. The weekly envelopes were real cash, but they did not outrun the loss of value inside the fund. This is why Income Autopsy refuses to rank income ETFs by yield alone. The distribution is a transfer. Total return is the report card. Risk is where we stop admiring the cash register and check whether the floor underneath it collapsed. TSLP's maximum drawdown was negative 62%. At its worst point, the decline was extreme. TSLW's maximum drawdown was negative 70%, even deeper. Both funds exposed holders to the kind of loss that can test patience, spending plans, and the ability to stay invested. TSLP held up better in the drawdown comparison, but better here means surviving a less catastrophic fall, not enjoying stability. The payout trends add another warning. TSLP's first four distribution average was 53 cents per share. Its latest four average was 34 cents. The latest average equals 63% of the early average, so the payout declined. TSLW's first four average was 29 cents, while its latest four average was 16 cents. The latest average equals 54% of the early average, so its payout also declined and it retained a smaller share of its initial distribution level. Direction matters. Neither fund's recent payout average rose. TSLP moved from 53 cents to 34 cents. TSLW moved from 29 cents to 16 cents. That does not mean every future payment must fall, because these strategies respond to market conditions and portfolio outcomes. It does mean the supplied trend runs downward for both, with TSLW showing the weaker retention. Now combine the type of risk, not just the depth. TSLP is vulnerable to a difficult trade-off around Tesla volatility. If Tesla drops hard, premium can be overwhelmed. If Tesla rockets upward, written calls can limit participation. If option pricing becomes less generous, the cash-producing opportunity can weaken. The manager has flexibility through active management and flex options, but flexibility is not guaranteed protection. TSLW faces a more direct amplification problem. Its objective increases exposure to Tesla's weekly price return. Volatile reversals can be especially punishing because gains and losses strike a capital base that keeps changing, while cash is also leaving through distributions. The product's much smaller asset base adds a practical fragility worth monitoring through current fund documents, even though the supplied data does not establish any closure or liquidity outcome. Small is not automatically doomed. Small simply deserves scrutiny. Distribution cuts can hurt on both sides of the statement. The investor sees less cash arriving while also seeing a lower fund value. That is why someone using either fund for spending should stress test the plan against variable payments rather than mentally converting the headline rate into a salary. The recent averages show that the check can change materially. The risk verdict within this beat is therefore layered. TSLP had the shallower maximum drawdown and preserved more of its early payout rate. TSLW had the deeper drawdown and the steeper deterioration in distribution retention. Both carry concentrated Tesla-related risk, but the leveraged weekly design made TSLW the more damaged record in the supplied evidence. TSLP earns comparative credit, not immunity. The assigned verdict for TSLP is stable with a condition. That label fits the full autopsy. The fund's NAV fell 42%, and its recent distribution average retained 63% of the early average. So nobody should confuse stable with a smooth share price or a fixed paycheck. The condition is understanding the bargain. TSLP trades away portions of Tesla's upside to collect option premium, accepts that premium cannot erase a major decline, and moves a meaningful part of the economic experience into monthly cash. In the supplied record, that bargain still produced a positive 34% simple distribution-inclusive return. The machine did what it promised well enough to leave the total result above water. The assigned verdict for TSLW is cause of death, NAV erosion. That is blunt because the evidence is blunt. The NAV fell 66%, the latest distribution average retained 54% of the early average, and the cash distributions were not enough to prevent a negative 10% simple distribution inclusive return. The weekly payment stream looked alive, but too much of the underlying capital disappeared. On this record, the distribution was largely the holder's own capital coming back rather than a sufficient economic gain. Head-to-head TSLP is the healthier patient. It lost less NAV, suffered the shallower maximum drawdown, retained more of its early payout level, and finished with the stronger all-in outcome. That conclusion follows the evidence. It is not a promise about the next Tesla cycle. These remain different tools for different goals, not a buy list. TSLP is a conditional income strategy for someone researching whether option premium and capped upside fit a Tesla-linked objective. TSLW is a high-risk leverage trading tool whose weekly cash feature does not cancel the danger of amplified losses and capital erosion. The right research question is not, which yield is bigger? It is, which machine matches the job and what failure mode can the plan survive? For either fund, the answer depends on the investor's goal, time horizon, tolerance for drawdowns, need for dependable cash, tax situation, and willingness to monitor changing documents and distributions. Verify the current facts, understand the mechanism, and judge cash received together with value remaining. This comparison is research and education only, not a recommendation to buy, sell, or hold either fund. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick and what matchup should we run next? We read everyone. Thanks for watching.